Hi, good evening, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight as we talk about 2023 market outlook. There is people joining from Singapore, from Malaysia, from Thailand, from Hong Kong, and from the Middle East, where we are present. And actually, we're also trying to be in different places as well. So I have joining me tonight our two co-CIOs, Stephanie, who's actually in Hong Kong, and Freddy, who's in Singapore, while I'm currently in Kuala Lumpur. So we're also spread as some of you are. Tonight, obviously, it's an interesting time to think about the future and try to do a market outlook. And in fact, we title it "Uncertainty Breeds Opportunities." We'll try to talk about those uncertainties. We'll try to be pragmatic about it, and maybe in ways that the more the larger banks do less. So we'll try to give you some real in-depth thinking about what's happening, what could happen, and how you can think about your investments looking forward. Now, Stephanie, if you can help me go to the next slide. The way we structured the evening is that we first will start with a recap of what happened last year, both from a markets perspective as well as looking at how our ERA portfolios have done, our StashAway portfolios have done. We'll then look at 2023 outlook, and we will look at how to position in this environment, and we'll have time for Q&A. So maybe a couple of points here. So first of all, you can feel free to use the Q&A function in Zoom to write your questions. I will play the role of trying to make sure we address as many questions as possible, and I'll pose this question to Stephanie and Freddy, and try to, you can do it throughout the presentation, while I'll probably try to address them mostly toward the end. Now, as we start speaking about the ERA position in the StashAway portfolio, both looking back to the 2022 review as well as looking forward, this obviously talks about our core set of portfolios. As you know, on the StashAway platform, you'll also find other solutions like our cash management solutions, as well as our BlackRock portfolios, as well as our flexible portfolios. Tonight, we are focused on the ERA managed portfolios, and that's the way we're the angle we are taking as we look at the markets, both looking back as well as looking forward. So I think I just want to let Stephanie and Freddy give a quick hi before we start, and then we can move on.
Hi, everyone.
Hi, everyone. Well, good evening from Hong Kong, and welcome everyone again.
Perfect. So look, Freddy, do you want to start by looking back before we look forward?
Sure. Thanks, Michele. If you just move to the next slides. It's not new. I always know 2022 has been a very tough year for nearly almost any asset classes you can find. That the picture is not pretty, but just to highlight how challenging it was, is to look at a classic benchmark of having a 60-40 portfolio. 60-40 means you have 60% allocation in a global equity sort of portfolio, and also 40% in global bonds. And as you can tell, that the performance is pretty awful in 2022. In terms of year-to-year performance, is some of the most extreme negativities in the given year basis for this portfolio. And the big reason, and what is being reflected here, is that both bonds and stocks are down in a very, very big similar manner. And that's got to do with rate hikes and inflation, and also a slowdown in earnings growth. So this picture really summarizes very, very well. The safe assets challenged, growth-oriented assets challenged. Next slide, please. I will try to navigate you to this because it might not be very visible. What this picture tries to do is to show you a year-to-year winners and losers. So if you look at 2022 towards the right-hand side, the second column on the right-hand side, you see that there's only 3 winners over there. Commodities, 22.4% up in 2022. And then infrastructure is 21%, cash is 0.9%, and virtually every other stuff's down. US equities down 14.5, and so that goes the picture. The other vintages or years, you see different winners up there and different losers down there. So this is a very unusual environment where it's a bit like 2018, where most asset classes loses money. And the averages, which are just to help user, help all of us here have an easier comparison to what's to be expected normally. The rightmost columns just shows you the historical long-term averages on an analyzed basis. So on average, US equities historically has done 13.3 percentage point over the last decade and a half or so. And so you can see that now in 2022, it's sort of down there at minus 14.4, right? So this picture really summarizes the challenges for 2022. Next slide, please. Well, despite a very challenging environment, and we knew that the environment started with Russia invasion of Ukraine, that really stressed food and energy prices globally. And then China's zero COVID lockdowns has further stressed supply chain adjustments globally. And these two really filtered into a lot of increases in headline inflation. So despite a backdrop of higher inflation challenges, the StashAway portfolios, when you lay them up against the respective same risk benchmark, in 2022 itself, we outperformed by between 2% to 8.5 percentage point, depending on which particular risk index you are on. However, obviously, everything is still down. It's just being less down. That's a story here. But this is actually a very important thing. If I can go to the next slide. In terms of averaging across all different portfolios on the platform, the source of outperformance against the same risk benchmark came from primarily from energy equities, which obviously gained from rise in energy prices because of Russian invasion of Ukraine. And also gold actually has done well relatively. Well, you may say that the gold's contribution is notable, but it's not as high as expected. And one of the reasons is because gold is a set inflation hedge, but it's also sensitive to interest rates hikes. So interest rate hikes sort of take away quite a bit of returns in 2022. Alternatively, a better view to look at gold is to think about gold as a insurance against paper money, fiat money, depreciating. So when you have interest rate hikes by global central banks because of inflation, they're trying to catch up to it. What happens is it's now more and more attractive for you to park in fiat money as short-term deposits, because the rates are just a lot higher than before. So that sort of took a lot of ooze from gold, even though inflation was rising. Obviously, on the outlook part of gold can be quite different. You got to be forward-looking. But in 2022, that's a story. The upside from it being an inflation instrument was pared back a lot by central bank hiking. Right? So that's a story there. Next one, please. As mentioned before, we sort of briefly mentioned that even though our portfolios are down, it is important to keep gaining an edge against the same risk benchmark, because if you are long-term investors and you are patient and you are consistent with investment plans, what you need is this edges, this extra advantages against the benchmark year to year, and you start seeing the effect over time compound. As you knew, the benchmarks is nothing mediocre. The benchmark itself, over a very long data period, as a lot of sources online you will find, they do gain very, very attractively, very respectably. Now, if you are able to edge out an advantage against the benchmark in down years, and you try to sort of keep up with the benchmarks in good years, the advantage is even more attractive and respectable. So it is very, very important to have a portfolio management technique that lessen the drawdown in tough times. So you keep gaining those edges and those compounding power if you're patient. Now, I don't know if there's one more slide, but I think, So that's my section. Just to summarize, inflation making the market challenging, energies and gold a big source of the outperformance at StashAway versus benchmarks, and the importance of being patient and consistent to your plans, and in the importance of having a framework to lessen the blow in downtimes. This is very important. Those edge will compound as you keep chugging along. Yeah. So I'll leave the mic to Stephanie to look forward.
Maybe before we look forward, a kind of couple of questions. Maybe one is to summarize what I've kind of looking back at the performance. Overall, there is a 5.3 percentage point overperformance of the 12 ERA portfolios versus their respective benchmark, which this slide shows comes mostly from energy equities, gold, floating rate bonds, US small cap equities, and US tips. I'm just going in decreasing order from the bottom. It looks like the inflationary edges that we put in place in the portfolios in early 2022 kind of worked well. And I guess that, Stephanie, in the next section, you're going to look forward and talk about, how 2023 is different from 2022 on this sort. But I do have a kind of a question from Freddy. I think a lot of people don't know why bonds performed so poorly last year. A lot of, historically people think when bonds are a good kind of a hedge against equities, when equities go down, bonds goes up. And last year, as you mentioned, was actually the worst year in the last 100 years in terms of negative correlation, positive correlation in a negative way of both bonds and equities. Can you explain briefly why bonds suffer so much alongside equities?
Well, that's a great question, and it has to do with the environment we're in the sense that you have a situation early in the year with very negative development, not just the war that drive up prices, but you're already seen a lot of slowdown in places like China and even Asia, ex-Japan, where cyclically there was a slowdown. But central bank having their hands tight because they were way behind the curve in fighting inflation, having allowed it to really run up and surprise themselves, had no choice but to prioritize inflation fighting over smoothing the downturn in growth. And so what you have is investors being caught in a very tricky situation where rates has to be hiked just when growth are slowing down. And so China's self-imposed zero COVID policy is self-added to a lot of sentiments. So yes, negative growth was supposed to be negative for stocks and positive for bonds, but the upside in bonds was massively overwhelmed by this significant rate hikes that's happening this year. And just to put into perspective, it's very unusual to see 75 basis point hikes, to start the rate hike cycle. We started it with 50 and then 75s. So you do have a very unusual central bank panicking over inflation early to mid of last year. So that's the reason why both stocks and bonds are down. Yeah.
Thanks, Freddy. Stephanie, do you want to take us into the future?
Sure. I guess, to that point, let's look at what 2023 actually brings. And I guess the teaser is that uncertainty actually breeds opportunities. And we think that actually 2023 is going to be quite different from 2022 in the sense that the risks are still there, but the set of risk will be different. And the opportunity we see is actually, I guess, broader than what we've seen in 2022. And that actually makes it quite interesting, or a lot more kind of dynamic for the coming year than what we've had in the past year. So I guess the biggest question that we ask ourselves as investors, without circling around, is the bear market of 2022 over? Now, obviously, given what Freddy has mentioned, we've had a bear market not just in equities, but equities and bonds. And these actually cover the majority of the asset allocations of most investors. So here tonight, we're trying to answer that question. Unfortunately, the answer is quite a bit nuanced. So, I mean, I put a quite a confused bear here. And I think after tonight's session, we'll find out why we think, yes, the bear market of 2022 is over. But is the bear market over? Are we out of the woods? We don't think that's necessarily the case. So let's take a look back. I guess Michele asked a question about, so why was 2022 so special? I mean, this chart actually summarizes very nicely what kind of environment we were in terms of inflation. This is a US Consumer Price Index, the CPI. So basically, the blue line tracks the year-on-year change in terms of prices in the US. What we've seen is in 2022, the CPI year-on-year change has reached north of 8%. Now, for most of us who are still, I mean, quite young, the last time that US saw such a high inflation was actually in the 80s. That was when, I mean, a lot of us were still very, very young, or even not even born. So this is a very, very different environment compared to what we've experienced in the past 30, 40 years. And I guess what that kind of results in is a significant valuation compression. When we say valuation, a lot of us think about, oh, PEs for equities. So for example, the S&P here, we have a price to earnings ratio. Basically, you take the price level of the S&P index and divide that by the earnings per share of the companies that are within the index, and you get so-called a price to earnings ratio. So this price to earnings ratio actually refers to how expensive a particular stock index is. So for example, we see that in the left-hand side of this chart, when we started in 2013, the S&P was actually trading at 13 times earnings, which means that investors are willing to pay a price of 13 times of that particular year's earnings to buy the companies. It's actually been rising, and as recently as maybe in 2021, the S&P was actually trading at 21 times. So 21 times was actually a lot more expensive than 13 times. And this was a result of money printing, of the quite loose monetary policy that central banks have been accommodating. What we've seen in 2022 is that the S&P price to earnings ratio fell back to a historical kind of more normal range, which is around 15 times. So that was actually caused by interest rate hikes. And because if you think about kind of the way equities is priced, it's linked to a premium that you give to the risk-free rate, i.e. if you can put your money in a bank and earn, let's say 5%, when you buy equities, you would demand a return that's higher than that 5%. So when that 5% actually increases, the return that you you would demand from holding equities also needs to increase. So that's on the equity side. When we say valuation, we can also apply that to bonds. And as we all remember, US Treasury, the risk-free rates were actually below 1% just a year ago. And the other, I guess, 1% is historically very, very low. And when we start from a valuation that is so high, i.e. meaning bonds are very, very expensive, when you go from like 1% rate to 4% rate, that kind of hits the price of bonds very, very seriously. So we had an elevated valuation, both in equities and bonds. And in summary, what happened in 2022 was basically a valuation coming off, i.e. expensive stuff becoming cheaper. But we think actually that regime is shifting. So when we say the regime, we in 2022, it was a high inflation regime. We think that the high inflation regime is actually shifting. And that is actually what we track on a real-time basis using ERA and the data input that feeds into ERA, our economic regime asset allocation-based model. So in ERA, for those who are quite new to StashAway, in ERA we track both growth and inflation. So I have two graphs here. On the left-hand side is growth. So basically, if you think about growth and inflation and the economic cycle, they go through like ups and downs, peaks and troughs. So stylistically, if you look at where we were in terms of growth, on the left-hand side, we were actually in expansion. So the green line is 0. So when the when we're going through the cycle above the green line, the economy is actually expanding. And when it actually falls below the green line, the economy is contracting. So now we've actually just entered a economic contraction in the sense that, I mean, growth numbers are actually falling below zero on a year-on-year basis. On the other hand, on inflation, we were actually in the accelerating and high inflation cycle just a few months ago. And I guess in the last 2-3 months, we've seen actually inflation numbers peaking in the States. And we're actually still in a high inflation regime, but that high inflation is also falling. So, I mean, this is why we think actually the inflation and growth environment is quite different from 2022. Now, this is a era quadrant that we've actually been using for the last 5-6 years. And a lot of you have seen this quite a number of times. So, I mean, just as a quick recap, this is just, I mean, putting growth and inflation into 4 quadrants. And on the left, on the upper side of these 4 quadrants, we have good times, which means that you have good growth. You have growth actually accelerating, but inflation is still quite low. So companies actually enjoy earnings growth because you don't have, you have revenue growth, but you don't have margin pressure. As the economy actually starts to accelerate, then, I mean, people would demand higher wages, companies would raise costs, raise prices. That's when you enter into inflationary growth. And actually that was where we were for most part of 2022. Now, we've done a re-optimization in December, just a few weeks ago. And that re-optimization was actually triggered by another move into the next regime, the next quadrant, which is stagflation. There's no, I guess, if you look at the media or a lot of literature, there's no set definition of the stagflation. A lot of people actually refer to a slowing growth plus high inflation. Here at StashAway, we refer to actually negative growth but still high inflation. So this is exactly the regime that we've seen in the previous page, which means that, which is why we've moved into stagflation regime in December 2022. Now, as the economy actually starts to slow because of high interest rates and demand actually falling off, the economic cycle then would move into recession, where inflation would start to fall because of the demand kind of drop off. And I mean, growth is still quite negative. But at this point, central banks typically would start to stimulate the economy and then move actually growth upwards, and we go back to the good times again. So basically, I mean, this is a cycle that repeats itself over and over again. And this is why at StashAway, we can use historical data to determine where we are in the economic cycle and position accordingly. And this is why systematic allocation works, and historical data is very, very useful. So in summary, we think that in 2023, the difference versus 2022 is that growth will actually overtake inflation as the key investor concern. Just to go a little bit more into the data, here is a chart of US CPI. So a few months ago, we actually showed this chart with the plotting the dark blue line. Basically, that is a calculation of the year-on-year change in commodity prices. So what we were trying to predict or forecast back then was, if we hold commodity prices unchanged for a few months, given the year-on-year effect in commodity prices, we actually see the year-on-year change in commodity prices falling to 0% in 2023. And historically, commodity prices has actually been a very good leading indicator of the CPI number. And a few months later, when we roll forward to right now, we actually do see the US CPI number rolling over and peaking. And right now, if you look at the, the light blue line, the dotted area is taking the median economist forecast. And indeed, I mean, the sell side of Wall Street also expects the inflation to come off pretty quickly to around 3% by the end of 2023. So 3% is kind of within the Fed target of where they want the inflation number to stabilize at. And also the other way to look at kind of inflation is to compare it with historical cycle. Here we have a chart that shows in the red line historical kind of high inflation cycles and how fast that high inflation would fall. So the blue line is actually the current inflation cycle. As you can see, the rise in inflation is actually quite in line with historical kind of higher inflation cycles. And it seems like it's peaking, or the rolling over is also at a similar pace than compared to history. Again, I mean, this speaks to why, I mean, history is actually very useful in looking at or in forecasting what we're going to get. However, with inflation kind of declining, there's a cost. The reason why inflation is declining so quickly is because, of course, the Fed has aggressively hiked interest rates, and they have tightened monetary policy very, very dramatically. And to the sense that, I mean, Powell actually has repeatedly said there will be tough times, but we need to get inflation down. And so the key risk in 2023 is the word that nobody wants to speak about, which is the R word, recession. This is a chart that shows you the probability of a recession occurring in the US in the next 12 months. And as you can see, right now, the probability calculated by New York Fed is actually 47%. So this is historically a very, very high number. The last time we've had that was during COVID, during the financial crisis of 2008, and also post the dot-com bubble. So this is, of course, a major concern because it affects all asset classes. Now, Michele mentioned a bit about Wall Street predictions. So we've done a quick homework, trying to look at what the Wall Street economists or asset allocators are saying. There's a lot of details to it, but we'll spare you of that. What we've done is actually to look at who's in the camp of recession, who's in the camp of no recession. Interestingly, I mean, we found that Wall Street was actually split in half. On the left-hand side, you can see Bank of America, Barclays, BlackRock says we're going to get a recession. On the right-hand side, Goldman, JP Morgan, BCA Research says, oh, no, we're not going to get a recession. We're going to have a soft landing, which is a very, very ideal scenario. So, I mean, if you look at all these predictions, it's very, very hard to draw a conclusion. So, I mean, what can we do? We look at the data. So at StashAway, we have ERA actually tracks real-time data in terms of growth and inflation. This is a time series of the growth indicator that we track. As you can see, we also compare that with the ISM, which is a very, very good kind of leading indicator for the US economy. As you can see, I mean, our growth indicator is actually indicating quite a significant contraction. The reason why we use the growth indicator is because it takes a broader set of inputs compared to just the manufacturing index, and also it gives us a real-time input into the model. The other thing that ERA does, apart from tracking real-time, I guess, data, is also, I mean, we try to look at history. We try to look at, what were the historical episodes that were closest to what we're experiencing right now, and how we can learn from history. So, I mean, ERA actually found a few very, very close, I guess, episodes. But the closest one that we found is actually the one that occurs in the 80s. Again, this was a very, very long time ago, but using data, you can actually travel back in time. Again, I mean, if you look at the 1980s, inflation was very, very high, even higher than what we have today. And the Fed was also trying to hike quite aggressively to bring inflation down. Here is on the top is CPI during that time, and on the bottom is Fed funds rates. Back then, we had double peak in inflation, and because during the first spike in inflation, the Fed actually didn't hike very aggressively, and therefore during the second spike, the Fed really slammed on the brakes. This time, I mean, Powell actually took lesson from this. That explains why he slammed on the brake really early on, because he didn't want to have like these double spikes. He wants to get inflation down right away, which is why, I mean, the 1980s was actually a better comparison than the early 70s. Now, what happened in 1980s when the Fed actually like slammed on the brakes? This is a comparison of the US ISM number. So for those of you who are not familiar, ISM actually is the Manufacturing Purchasing Manager Survey. So it's a diffusion index, meaning that you take 50 as the middle mark. So anything that reads above 50 means that the economy is actually expanding. If it falls below 50, it means that the economy is actually contracting. The blue line was what happened in the 70s. So I started the series from 1978. Of course, the trough was in middle of 80s. And what I did was also to take the current reading and draw a comparison. So the current reading started from 2021. And we're actually, so if I compare the timeline, where we are right now was very, very close to where the US economy was in terms of growth in the early 80s. Now, what happened was then, I mean, the US actually entered into quite a deep contraction. And you can see here, I mean, ISM actually fell to as low as 30. So 30 is a very, very low mark that, I mean, typically would actually precede or indicate a very deep contraction in the US economy. So, I mean, this is, of course, an example. Given many things could be different, I mean, we may not repeat it, but the probability seems to be quite high that we'll have a deeper contraction. And I said like there are many factors that are different. One very, very important factor that is different now versus the 80s was, of course, we have the central bank actually also contracting its balance sheet going forward. If we all remember QE, quantitative easing, in the sense that, I mean, the central banks actually print money to support the economy. And that was a very, very important tool that the Fed and other central banks globally have used to combat the economic contraction in COVID. So we can see here, actually, I mean, QE started in the financial crisis where you can see the G4, which is US, UK, the ECB and BOJ balance sheet actually started at $4 trillion US. Today, it actually sits at 22 trillion US dollar. It's a very, very significant jump. And I guess if you look at 2020, there was a significant spike in the balance sheet itself. And because the central banks are actually trying to tighten monetary policy, the central banks are trying to kind of take money back in, and therefore we're going to see a contraction year on year in terms of balance sheet, which actually affects the liquidity going into different asset classes. And in 2023, we're going to see the most kind of contraction in terms of year on year basis. Again, I mean, apart from central bank balance sheets, we also have potential kind of events happening globally that could affect the how different asset classes would perform. In 2020, of course, we had COVID. In 2021, we had President Biden being elected in the US. I mean, these are uncertainties that got resolved or events that happened. Last year, as Freddy mentioned, we have the Ukraine-Russian war. And I mean, this year, I put a crystal ball here because these are kind of things that is very, very hard to predict. Which is why we need to react to that very, very quickly. We need to have a system that knows how to react. I guess there are many events that can happen, and I'm just going to list one out here, which I think could kind of get more and more focus as time goes on, which is climate change. Again, I mean, this week we have Davos, and I'm sure like climate change is going to get discussed at Davos. I mean, already in this winter, we have very extreme weather in both Europe and the US. So in Europe, we have historically hot weather. In the US, we have like record snowfall. And the impact of climate change on it's not just on the environment, but it impacts the economy. It impacts actually a lot of different aspects of investment as well. So, I mean, this is something that I guess potentially we can pay more attention to in next year. So yeah, that's it for 2023 outlook.
So maybe Stephanie, before we talk about positioning and we try to be, even more pragmatic on how can an investor think about the backdrop that you just explained, let me maybe ask you a couple of questions. First, there is a question from one of the listeners, Darren, asking, how does the reopening of China factors in some of the risks or the opportunities from a macro perspective before we go into positioning?
Yeah, I mean, that's a great question. Of course, the China economy has actually, if you look at data, China economy has actually been slowing down very, very dramatically I guess, in the past 12 months. A large reason for that is because of the COVID lockdown. Of course, there's other policies that are ongoing as well. For example, the anti-monopoly policies and the clampdowns on the internet sector and the property sectors. I mean, those are kind of more structural, but COVID kind of lockdown is a more cyclical factor that contributed to the weakness in the Chinese economy. We've seen actually a 180-degree change in terms of the policy in China just 2 months ago. And I guess the equity market and the risk markets have reacted quite enthusiastically to it. We think that actually it is a very, very important policy change in the sense that, number one, it helps to turn around the China economy. I guess we're looking forward to a kind of a pickup in terms of growth data coming out from China for us to get more positive. But already, I mean, we'll talk about that in the allocation section. We're already kind of getting, I guess, more positive on emerging market assets, which actually also includes China. A second kind of implication of the China reopening is also that it'll create demand for commodities and raw materials. So, I mean, it'll create some challenges for, I guess, the US in terms of when you have the economy that's slowing, but you have China kind of competing for resources, and particularly in a world where I guess the two countries are moving more apart than together, that could create some more friction in terms of the externalities and the geopolitical kind of conflicts that we talked about.
Thanks, Stephanie. One more question that's coming from Luca, one of our listeners. Any view on currencies in 2023?
Yeah, great question. And we're actually going to talk about it in the next section. So maybe we'll save that for the next section.
Okay, sounds good. So maybe actually, why don't we move to the kind of positioning question? And there is a bunch of other questions that are from our listeners that I'm going to take at the end. Okay.
Okay, that was great. So let's move on to how to position for this, right? We know what is the biggest risk. We know inflation is no longer kind of the only picture in town. So I guess, again, the reason why we say there's opportunities is because the market is actually still trading the 2022 regime. So if we look at this chart, we can see that, I mean, bonds is down 18%. So was equities. So both bonds and equities were down 18% in 2022. And there was some rebound, but there wasn't a lot of rebound. And as we said, moving from a inflationary regime to a growth kind of risk regime actually have different implications for equities and for bonds. Now let's take a look at like kind of each individual asset class in I guess separately. So on the left-hand side, we can see that an economic downturn, a growth slowdown, means that corporates can actually no longer make that much money that easily, i.e. The corporate earnings is going to be lower. So this is negative for stocks. So it basically increases volatility for equities and particularly for sectors that are sensitive to the economy, for example, industrials, for example, financials. The investors would actually look for safe havens given these uncertainties in growth. And it also means that because US on a relative basis will not outperform the rest of the world that much, investors would need to start to look for diversification outside of the US. On the other hand, because inflation is actually moderating, rate hikes is coming to an end. And indeed, I mean, the Fed's own forecast is for the Fed to actually raise interest rates to about 5% or slightly above 5%, and they're going to stop. So we're already at 4.5. So the majority of the rate hike has already been done. And in this kind of environment, actually, bonds would actually have a better return. And in terms of US dollar versus other currencies, what we've seen last year was a very, very strong appreciation of US dollar when the Fed actually is kind of moderating versus other central banks. US dollar move will be less abrupt. And then lastly, I mean, gold actually acts as a better safe haven. So actually, I mean, ERA, we're not just here to talk about views. Actually, we have implemented these views, and ERA actually re-optimized all our portfolios to the new regime in December 2022, so that our customers, our investors are well positioned for the new environment. So we'll go through each asset class. I said opportunities, number one, bonds. And this is actually a graph of the 3-month US government bills. So this is really, I mean, a cash equivalent product, a cash equivalent, if you think about in terms of investment products or risk spectrum. Today, you can actually get 4.5% income from owning a 3-month US government bill, which is essentially very risk-free. So this is a very, very high number compared with the history. As you can see, we started from 0%. So for investors that are quite risk averse, this actually provides a very good option to generate income, particularly if you're uncertain about like where you want to be investing. Parking your money in these short-term US government bills gives you pretty good income. And these days we have ETFs that actually can help you to do it very, very easily. And that's what we offer on the StashAway platform. ERA also increased the allocation to these short-dated US government bills across all our portfolios, just given the better risk reward right now. So this is on a yield side. We think that there's also potential for bonds to have some price appreciation. The reason why I said that is because if you think about 2022, actually bond prices declined because the Fed was hiking rates. Now, when the Fed actually stops hiking rates and maybe later in the year, they start to think about, oh, when are we going to start lowering rates? I mean, that actually creates price appreciation opportunities for longer dated bonds. As you can see here, this is a real interest rate, i.e. on that graph, I plotted for the 5-year maturity, the difference between the bond yield and inflation expectations. And for a long time, I guess, if you look at kind of that graph, since in the past few years, that spread has actually been negative, i.e. if you buy a 5-year bond, you're not being compensated for inflation. Today, that spread is actually 1.4%, which means that you're getting on top of inflation, 1.4% return for holding long-dated bonds. So this is why I said like the valuation right now is a lot more attractive because your starting point is becoming attractive versus inflation. In addition, if we do get into a recession, we do get an economic slowdown, bonds actually tend to provide a much better protection. So this is an example from 2022 COVID. And the dotted red line is drawn on March 2020. I guess we all remember the market was actually very, very volatile. Equities fell very quickly. The S&P was down 30%. But if you look at US Treasuries, the yellow line, actually it went up in absolute terms. So for a portfolio with Treasuries, with equities, actually Treasuries provided very, very good protective characteristics versus the risky assets. The darker blue line is defensive stocks, and the lighter blue lines are the cyclical stocks. So defensive stocks tend to start a recovery sooner compared to cyclical stocks. So this is also something we'll talk about later. Lastly, if I look at bond returns, this is a chart that shows the US aggregate total bond returns in the past 47 years. So if I count the number of negative years, there's only been 5 years out of 47 that was negative. And last year was, of course, the most negative because we started from 0% interest rate. We started from a very, very expensive kind of valuation. But given how we've moved, given how much rate hike we've had this year, we think now the starting valuation is getting quite attractive. And so if history is a good guide, or if you just take the probability of 5 out of 47, and the chance that we're going to get a positive return next year is actually quite good. So that was for bonds. In terms of equities, we mentioned in the first slide that equities tend to not do so well in a deep kind of economic contraction. The reason is earnings downgrade. So here is a chart that shows you where the consensus actually expects S&P earnings to be. And I guess if you look at the lighter kind of gray bars, the consensus is actually expecting a earnings downgrade or a earnings contraction year-on-year fall of 4% in Q2 2022, which is actually the reporting season that will start to enter into this week. But actually, the street is still quite optimistic about the rest of the year. So they think that the rest of the year will just, be 0% growth, and towards the end of 2023, we're actually going to get 10%, 11% growth again. We think that this is actually quite optimistic, particularly if you compare it with history. So this is a chart that shows you the earnings progression of different years. And if you look at the years that were circled in 2020, the earnings EPS earnings per share estimates actually got revised downwards by about 50% and even more during the financial crisis. So, if you look at 2023, the earnings downgrades have actually just started. And if we look even longer in history, looking at the last 30 years or so, earnings actually typically fall between 15 and 30% in an economic downturn, depending on how deep that contraction is. So we don't think that the Wall Street estimates, the consensus estimates, or the market have necessarily factor in a full earnings downgrade. So here is another picture of the U.S. equity valuations. As I mentioned, the middle, the pink line is the price to earnings ratio. So price to earnings have compressed, but at the bottom line is earnings per share. Earnings per share is actually still quite high. So I guess apart from the US, we'll also look at globally what are some of the other opportunities. And here, we look at the PMI, again, the Purchasing Manager Index for the developed markets. Green means that the economy is actually expanding. Red means it's contracting. For most of the developed markets, we can see that they're contracting. So typically in a contracting market, the equities tend to not be so attractive. The picture is actually slightly different for emerging markets. Here we can see there's more green and less red. And particularly, I guess, pertaining to the question about China reopening, we actually think that the direction of travel is quite different for emerging markets, including China, versus developed markets. And hence, ERA actually adjusted our equity allocations accordingly. So the first thing that we did was, because remember the previous chart, in a contraction, actually defensive sectors perform better than cyclical sectors. So ERA actually allocated more to healthcare, for example, versus energy and financials. ERA also reduced allocations to commodity exporters, DM, in developed markets in Australia and Canada. And we've actually increased allocations to emerging markets. Just very quickly to go through FX. So last year was a very US dollar dominating market, meaning that whatever the Fed did dictated what currencies markets was doing, i.e. US dollar strength actually drove all currency pairs. And last year, actually, US dollar appreciated 25%, which is quite in line with historical US dollar appreciation cycles. We think that this year is actually quite different because of the Fed actually nearing its interest rate hike and end of the interest rate hike. And therefore, the currency movements will be much more dependent on individual pairs, i.e. what other countries are doing. For example, with the China reopening, actually renminbi strengthened a lot. The second thing is for example, in Japan, we've actually recently seen the BOJ, the Bank of Japan, starting to hike interest rates. And that actually caused the Japanese yen to strengthen a lot. This is actually quite important because Bank of Japan is the last standing bank that has been that is dovish in this rate hike cycle. And even in Japan, where there's always just a concern of deflation, we're starting to see inflation biting into the economy, and therefore forcing the BOJ to kind of take control. And I guess this results in the yield spread of US versus Japan to come down, and the yield spread of US Japan typically drives the US dollar versus Japanese pair. So the story here is that for 2023, we think the story is a bit more nuanced in terms of the FX side of things. Number one, each country or each central bank with their own monetary policies and also, I guess, kind of economic situation will dictate what how the pairs trade against US dollar. And then secondly, if I think about kind of the risk environment, if we're right about a global slowdown, a slowdown in the US and also kind of in most developed markets, the US dollar still gets some support. So in short, we think US dollar is going to be in a range bound kind of environment in 2023. So lastly, gold. Gold is also a very important balancing asset. As Freddy mentioned, I mean, gold actually was a good contributor, but in absolute terms, gold was still down in 2022. And a major reason of that was because US dollar was very, very strong. And gold is actually priced in US dollars. So when US dollar goes up, I mean, that typically is not that great for gold. However, we think that's going to change in 2023 because in a kind of more nuanced, in a more kind of tame US dollar environment, we think gold can then act better as the balancing asset. So ERA actually maintained our exposure to gold in 2023. And then lastly, I guess we talked about the upcoming kind of economic contraction and potentially recession. So a natural question that a lot of people ask me is, or ask us, is that why should I still invest with StashAway if we know that if recession is coming? So I have a few comments on that. Number one is that monitoring the economy actually takes a lot of work. You have a lot of different data points to look at, and then also to interpret. A lot of times, if you just look at the news headline, you get kind of confused and like scared. I guess scared a lot of times because newspaper headlines typically are quite negative. So if you just follow newspaper headlines, I think you may miss on some of the opportunities that we talked about. Secondly, I mean, ERA actually manages your portfolio according to your risk level. So I guess even in an economic downturn, if you choose your risk level according to, number one, your cash needs, number two, your risk appetite, then, I mean, you can actually weather through these economic downturns and enjoy kind of long-term returns that comes with kind of staying with your investments, or even, I mean, putting more investments when the opportunities actually present themselves. And I mean, we have the StashAway risk index, which is very, very useful in gauging your risk tolerance and choosing the right portfolio. So I mean, really ask yourself, is the SRI, is the StashAway risk index the right one for you? And of course, if you're not sure, I mean, we have a whole team here that can help you to select the best one. And then I would say it's 2023 is going to be a year where we have ups and downs. So dollar cost averaging, DCA, is a good way to take advantage of these ups and downs in kind of more volatile markets if you have some spare cash. And lastly, this is a chart that shows long-term return of equities and bonds. Of course, the white line is equities and the orange line is bonds. So if you have invested in starting from the 1990s, i.e. in the past 42 years, equities would have returned 9 times, bonds would have returned 2.7 times. So I mean, this actually spells out why, I mean, long-term investing is important. And of course, during the course of this kind of 9 times and 2.7 times, there are ups and downs, and there were some significant downs. So the key is actually to weather through these downs. So here is some key takeaways from tonight, if I can summarize. Number one is 2022 was unusually challenging, where we had both bonds and equities fell. And I think we've explained why that was the case and why we think going forward it's going to change. Secondly, even though era returns were negative, which is in line with how the bonds and equities actually both did, we had actually smaller drawdowns trying to protect our investors' assets. And when you have smaller drawdowns, the bounce back is also kind of bigger because you have less distance to travel to break even. 2023 will actually continue to be a macro-driven environment, the key risk being a recession, a deep economic contraction, replacing inflation risk. However, there are some opportunities. Number one, bonds. Number two, emerging markets, non-USD assets. Number three, more defensive sectors in equities. And then I guess lastly, gold. So as always, ERA and the StashAway team will adjust their portfolios and also keep you informed as and when the macroeconomic environment changes and new opportunities actually present themselves. So a chart that I'd like to leave everyone with. Here is a balanced diet and a diversified diet. I think we all know that to keep your body healthy, you need to have proteins, vegetables, carbohydrates in good proportions. I think that applies the same to portfolio management, particularly in 2023, because of all the different kind of opportunities for bonds, equities, different sectors, US, non-US. We think diversification and patience will be key to success. And with that, I wish every investor great success in 2023.
Thank you, Stephanie. And I have been monitoring all the questions, and I have a few that I want to throw your way. Maybe can you go back to the summary slide just once, so we can leave it here as a kind of a key takeaways as we talk about some of the questions. So the first, and I've tried to summarize because some questions are actually repeating each other. So I hope that everybody is patient with me as I try to consolidate some of these questions. So the first question that I'd like to ask you, and you kind of addressed it over the last few slides, but a few people were asking, okay, but given you are saying that there is a high probability of a recession, and therefore there is a high probability people assume that equities will kind of not do well, is the right thing to wait? Is the right thing to hold back? Is the right thing to kind of wait for something to change before coming into the markets? I know you've spoken about this in the last 3-4 slides, but maybe this is worth kind of talking about it a bit more.
Yeah, I think, of course, we all want to be timing the market exactly, buying exactly at the bottom. I think it's very, very tough to do, to buy exactly at the bottom. And actually, if you look at the longer term returns, buying at the bottom versus, buy it in the middle versus buy at the peak, doesn't actually dramatically change your long-term returns. The biggest difference actually comes from being invested versus staying in cash, because cash actually returns nothing. Whereas if you have bought in equities in the past 42 years, every year you have return of 7 to 8%. And I think the key here is, not to try to time the market, but to kind of set up a portfolio that is true to your risk. Because as StashAway, the reason why we have all the different risk levels, risk tolerance, is because we want to actually make sure that you can withstand some of the drawdowns that are associated with investing. I guess the other thing I'll say is that dollar cost averaging is a good way to kind of go into the market if you're not sure of the timing and also kind of the risk tolerance that you can withstand. A lot of people like to ask, is now the right time to actually invest? I would say that think about a few things. Number one is how much is the spare cash that you have to invest as a overall proportion of your net worth. If it's a significant portion, then maybe think about chunking it into at least 2-3 chunks, if not kind of spreading it out across the next 12 months. If it's a small amount, then of course feel free to kind of just put it into one go. But I would say also, StashAway has made it very, very easy for everyone to do dollar cost averaging and chunk it up. So that is a very good way actually to think about how and when to enter the market.
Thank you, Stephanie. I have one question on specifically StashAway. So the title of the previous section was 2023 positioning. Does it mean that this is not going to change? Does it mean that this is going to be static, or how you think about it?
Yeah, I mean, I guess to say it more precisely is how we start 2023. So if you think about, I guess, every year, like all the banks, ourselves included, we all try to say, oh, this is what we think for 2023. In reality, the macro environment changes all the time. I mean, there will be externalities. For example, nobody foresaw the Russian, or very few people actually foresaw the Russian-Ukraine war in the start of 2022. Of course, that changed trajectories of inflation. That changed quite a few things. So I think what is important here is that you react to the data. Number one, you capture the data. Number two, react quickly to the data. And then number three, actually understand how to position for the new regime. So this is kind of what we're trying to do at StashAway. I mean, we can all talk about what we think will happen, but I guess predicting what's going to happen doesn't add that much to investment returns, because the market actually reacts real time to these events that unfold. So I think it's important to be like slightly ahead, but not too much ahead.
Thank you, Stephanie. There is a couple of questions on China, and there was one earlier on the economy we talked about, but there is a couple more on whether China is now an opportunity. And whether it's included in the current positioning of StashAway's ERR portfolios. Sorry. Yeah.
So I mean, China is a significant portion of emerging markets. In fact, I mean, China makes up 30+% of the emerging markets ETF. And I guess we've actually included the emerging markets ETF into our StashAway portfolios in different proportions, of course, according to the risk level of the portfolios, given that emerging markets is actually inherently quite risky. So bigger portion in the higher SRIs and lower portions in the lower SRIs. But I think there's several factors that led us to actually reallocate back to emerging markets. Number one being China actually starting to reopen. And if you look at Chinese assets, they perform way better when the China economy is expanding. I.e., for example, if you look at the China PMI when it's above 50. I guess one big reason is because you don't invest in emerging markets for dividend yield, for example, or for defensiveness. You actually invest in emerging markets for the earnings growth. And for earnings, like for the companies to actually make earnings growth, you need a good kind of economic environment. So, I mean, we haven't seen a full U-turn or a full recovery of the China economy, but we think that's heading in the right direction. And particularly after after first quarter, because right now it's still it's still the flu season, and in terms of the COVID cases is still climbing. So we don't actually see a full kind of reopening of the economy until the weather gets warmer in the second quarter. And I guess that is when we think the data, or hope that the data will actually start to pick up, and that allows us to become even more positive. Second thing I'll say is that a strong US dollar environment is actually not great for emerging markets or for non-USD assets. But as we've spoken about in the FX section, we think that in the next kind of 12 months, the US dollar strength is going to become more muted, and that actually creates more opportunities for these non-US dollar assets.
Thank you, Stephanie. I have one follow-up, actually two follow-ups. One actually from my perspective. So you mentioned China, and you mentioned that actually in the re-optimization that was carried out in December, there is some China allocation through the emerging markets ETFs and asset class. I just wanted to flag to clients that obviously for those that might want direct China exposure, this is now possible through the flexible portfolios option, where there is both a broad China ETF as well as a China tech ETFs to get those exposure. Those are actually Hong Kong traded ETFs, so they're actually not unlikely to go through any problem with the China-US trade war. Now, the follow-up I wanted to do on what you just mentioned is on US dollar. Mm-hmm. And there is one of the on the guest tonight, James, that says, are your investment via StashAway based in US dollars? In one slide, he read that the opportunity resides in non-US dollar assets. Am I missing something here? So maybe worth explaining the difference between kind of trading currency and underlying currencies and how we think about US dollars.
Okay, yeah, that's a great question. So I guess yes, I mean, the StashAway portfolios are based in US dollars, but it doesn't mean that we have only US dollar exposure. The reason is basically, I mean, separating the underlying fundamental exposure, the currency exposure versus the listing exposure, the listing currency exposure. So let me just, explain why StashAway portfolios are in US dollar, because for most of the ETFs that we purchase in the portfolios, they're listed in the US. So when an ETF is listed in the US, they trade in US dollars. And hence, I mean, the portfolios are actually in US dollar to trade in US exchanges. Now, even though a ETF is listed in the US, it doesn't mean that it has 100% US dollar assets. One very simple example is, let's take an Australian equity ETF that is listed in the US. Now it's trading in US dollar. However, all the companies that are inside the Australian ETF is actually Australian companies earning revenues in Australian dollar. So fundamentally, the exposure is actually to Australian dollar, but it gets translated back into US dollar for the particular ETF listing. So when we say non-US dollar assets, we actually mean the fundamental underlying companies that makes up these different ETFs or asset classes. I hope that's clear.
Yes, I think so. So in practice, short answer to James is, yeah, there is actually, so the current positioning actually tries to address the fact that there is a lot of opportunities in non-US dollar assets, even if some of the ETFs that we use to get exposure to those non-US dollar opportunities are traded in US dollars, right. But it's a wash. It doesn't matter to your final exposure. So thanks, Stephanie. Now, there was a couple of questions about risk, right? You talked a lot about recession risk. Nobody knows, you said some banks are projecting a recession, some others are projecting a soft landing, but there is definitely a risk of recession, and the 47% according to the Fed. Now, how the current positioning after the last re-optimization tries to protect portfolios against this risk?
Yeah, I think I guess across all portfolios, we've actually added exposure to balancing assets or protective assets. Now, in this case, just a very, very broad brush, protective assets includes bonds and gold. So we've actually increased allocations to bonds, particularly for short-dated bonds, because if you remember the slide on short-dated US government bills, they're right now yielding 4.5%. So we do see that, that is quite an attractive absolute return in an environment which continues to be quite uncertain. And we've also actually increased allocations to longer dated bonds as well, because we see that, the yield is going to stabilize, and then also there is potential for some price appreciation. Secondly, in terms of balancing assets, we mentioned gold. Gold is, we've actually maintained exposure in all our ERA portfolios because, we think that gold this year can actually act as a better kind of balancing assets in absolute terms, given that the number one, US dollar is going to be a lot more range bound. And then number two, I think there's still an ongoing concern kind of geopolitically and politically among the kind of major powers globally. So in that case, gold remains actually a safe haven asset should some conflicts actually happen.
Thank you, Stephanie. There is a question around StashAway Simple, actually. Say, what does this current environment mean for cash management products, so StashAway Simple, and for Singapore clients, StashAway Simple Plus?
Yeah, I think, for a lot of our clients, you've seen your interest rates actually climb in the past 12 months or so. And for Simple Plus in particular, it's a high risk, product compared to Simple, but still the risk of Simple Plus is way lower than our kind of general investing portfolios. But it doesn't mean that it is not immune to the fact that, I mean, bond prices actually fell in a rising interest rate environment. However, if you think about kind of today, like Simple Plus is also, I mean, yielding 4 point, kind of north of 4.5%. And I mean, that is actually a very, very good buffer in terms of counteracting the potential price depreciation from further interest rate hikes. So I would think that, I mean, right now is a good time to invest in both products. If you are kind of more risk averse, then, I mean, Simple is a better option. If you are comfortable with some mark to market and you want to have like higher returns, then I guess Simple Plus would be a better option.
Thank you, Stephanie. And so, in general, given the current interest rate environment, yield will continue to be where it is, or probably rise a little bit if rates goes higher. I think that's true for both Simple and Simple Plus, and we'll see, as conditions stabilize, probably yield remaining there until the central banks will start potentially reducing rates one day. There were a couple of questions about StashAway more specifically. I want to leave them for last. So let me see if I actually reply to. So there are a couple of questions actually about more of our long-term investment. So people are saying, hey, how do I position myself given that, you have a year like 2022 where you lose money? How do I see this in the context of my long-term investments? How do I think about it? And Stephanie, you showed a slide earlier with long-term investments, and you see 9x over the course of the last 30 or 40 years for equities. So how would you suggest people think about the ups and downs that are natural in investing, particularly if you are actually taking a bit of a kind of a equity risk, or the more equity risk you take, the more you see these ups and downs? And maybe as an attached question to this, there was a follow-up, and it was a question from Melvin, I believe, earlier, saying, given the backdrop of the information you gave, does it make sense to think about portfolio positioning as, reducing risk, and so having a higher allocation to bonds than equities, for instance?
Yeah, I think, no, I guess in the investment world, there's no free lunch apart from the application. So to generate higher risk, to generate higher return, you need to take up higher risk. So higher risk means that in terms of, in this context, means that there's going to be more potential for drawdowns. So I think as investors, we need to think about what are the level of drawdown that we're comfortable with, because most investors actually, in the long term, it's not that difficult to make money, right? You just stay with the investment and you can obtain these returns. A lot of times, the reason why investors lose money, or that we lose money, is that we kind of cut losses at exactly the wrong time at some of these drawdowns. And I guess the psychology pressure is quite high when you don't know what kind of drawdown you're looking at potentially. Particularly, I guess, when the news headlines are all negative and the environment is uncertain. So the StashAway risk index is actually set up to help our investors to kind of stay invested even during difficult times, because the more you can understand the drawdown, the more you get comfortable with the drawdown, I guess the more you can take advantage of these kind of market downdrafts. For example, if you are, let's say you have a 20% SRI portfolio, right? So the drawdown you should expect in a very bad market should be around 20%. And if you have already psychologically prepared for that, you, instead of panicking when the market actually falls, when your portfolio actually falls 20%, you can turn around and think, oh, actually, I mean, the market has fallen that much, right? And typically, this is how historically markets have fallen before they start to recover. So instead of trying to panic and think about, oh, should I cut loss here? A psychological trick could be that, oh, actually, maybe now it's time to put in more money and to take advantage of it rather than to panic from it. So I think that's the power of having control over a portfolio even in terms of drawdowns. And I think is actually how you generate even better returns than just doing nothing. I guess yes. The second question with regards to how do you I guess make use of the SRIs or the I guess make use of your different risk appetites. I think shifting to different risk appetites may not be the best strategy unless your current risk appetite is not the one that you're most comfortable with. So the best strategy is actually to review your current portfolios, see if the current SRI makes sense. Our customer service, customer experience, and wealth advisors are all here to help to guide you through the selection. So make good use of that. Perfect. Thank you, Stephanie. Now, maybe there are a few more questions that are coming in, but also I'm in the interest of time. I feel that we have addressed most of them one way or another. There is maybe a couple of questions I wanted to answer myself on, not specifically on the topic. One was more broad about the difference between kind of the ERA portfolio and the BlackRock portfolios. And as mentioned at the very beginning, tonight's session was kind of the applying an ERA filter on the macroeconomic environment. Of course, the macroeconomic environment is the same whether you invest using the ERA portfolios or the BlackRock portfolios. But some of the filters that Stephanie used in the presentation are looking at it from a macroeconomic economic regime perspective, and economic regimes is what drives ERA's logic. You can decide whether to invest with the ERA portfolios or the BlackRock portfolios, or build your own portfolio with flexible through the StashAway app. And the difference is that the BlackRock portfolio will be managed through an asset allocation strategy that is developed and maintained by BlackRock, and therefore will be slightly different from the investment strategy that Stephanie has mentioned a few times today as she was talking. In particular, the BlackRock portfolios are more inclined to stay close to the benchmark, while or the 60-40, 80-20, or whatever the benchmark will be for a specific portfolio, while the ERA portfolio is actually risk-centric, so it attempts to keep risk constant while maximizing returns at any level of risk. This is kind of the conceptual difference. You can actually explore the differences on the app, and it's quite clear to see what the differences are. But the overall philosophy is similar: is diversification across asset classes, making sure you actually capture opportunities in different pockets of both the equity markets, the bond markets, as well as the real estate markets, actually, and the commodities market. And then there was also a question about kind of broadly speaking about StashAway, how we've been doing. And we've actually been doing quite well. Obviously, last year was a difficult year for the markets, but as a company, we did a lot of good things. I think we've launched, as I mentioned, the BlackRock portfolio. We launched flexible portfolios. In Singapore, we launched our StashAway Reserve offering with private equity, venture capital, angel investing, and crypto. We launched earlier in the year. We launched ESG options as well as thematics, and so we actually kind of did a lot of work to make our offering even more complete and give more options to clients. And we see most of our clients actually continuing to invest through the ups and downs, which is what long-term investing is about. Is as Stephanie mentioned, taking advantage, making sure you have the right risk level so you can live with it, and taking advantage of the ups and downs that the markets present, seeing the downs as buying opportunities. And we've seen that quite a lot of clients doing that, which is great, as we've been talking about it for the last 6 years, and we will continue to do so for the next 30. So the short answer to the question is that we've done well, and we continue to work with many clients trying to help navigate this, the natural ups and downs. And one thing I always like to say is that if you are in your 30s and you think you're going to retire by age 65 and you have 30 years ahead of you, you'll go through 6 or 7 bear markets and 25 corrections. So it's going to be very difficult to avoid all of them. You need to embrace them and try to kind of make sure you are positioned right, because the alternative is not to invest. And if you don't invest, your money is not going to work for you, and your retirement will actually look significantly more difficult if you don't leverage the compounding power of investing over the course of 1, 2, 3 decades. So we're here for that. We're here to help you achieve that.
Let me just double check if there is anything new that I haven't looked at. I think broadly we answered most questions. Any parting thoughts, Stephanie or Freddy, or both?
Freddy, do you want to start first?
I want to sort of give an honest assessment. Like I saw comments on China as well. Just want to say, you know, as fund managers, we will never feel, you know, great when things are down, but also a very difficult part of our job over my 20-year career is that when you're down, you got to look for opportunities. And then actually when we are up, we're actually quite afraid of what's going to happen next. And we always think about risk. It's always the reverse. It's always been reversion that we are thinking about. And so 2 years of underperformance may seem like a long time, but as Stephanie's chart earlier shown, that goes back to the 1990s, is like a really small blip on the chart, you know, on that white line S&P. And you may feel like that's long-term, but it's not. We just got to keep going, keep savings, you know, keep trying to rein in expenses, keep having net savings every month and keep deploying them systematically over your lifetime until you retire. I mean, that's how to realize the power of the chart, the 9.7x and what have you. So I just want to sort of leave you with that. Stephanie, if you have anything else?
Yeah, I just want to say that I guess, yeah, one thing that we'll try to do kind of much more also in 2023, given the uncertainties, is to really step up on communication and to make sure that everyone is informed of the things that we see, the data that we're processing, and kind of the asset allocation implications that we generate from StashAway. So hopefully, I mean, it's going to be a difficult environment, but we're all here with you and we're in this journey together.
Thank you, Stephanie. Thank you, Freddy, and thanks everyone that joined and stayed on for close to an hour and a half. I appreciate the attention, and obviously, if there are questions that I wasn't able to get to, please feel free to send it to support@StashAway.sg, and we'll, you know, our team will be able to reply to your questions and address them. As well, I saw a few people asking for a recording. You can do the same, asking at support@StashAway. Thank you so much, and I wish everyone on the east side of our countries good evening, and I guess good late afternoon for people in the Middle East. Thanks, everyone.
Thank you.
Bye-bye.